Welcome. My name's Chris Shepard. We've got AJ Shepard and Trent Warner here, and we're excited to present Uptown Syndication's Cloverleaf investment opportunity. It is 40 units in Southwest Portland. It's an area that AJ and I have both lived in, and we're extremely excited to buy this apartment complex. I think that we've driven by it thousands of times.
Thousands of times. It's also zero point 0.8 miles from our management office, so that helps too.
Oh, wow.
Yeah. We just did the inspection on the property, and we've got a very good understanding of what needs to happen. And all in all, we're getting it at a very good price. One of the rules that I've always used in purchasing real estate is the 1% rule. And if you're able to acquire a property the purchase price being below 1% of the gross rents, that I'm going to talk about our kind of bread and butter property management value add plan. But we're extremely excited to present this opportunity. It's above a 17% IRR, which these days has been pretty tough to find an investment that's above a 15% IRR, just the way the interest rates are. And we're going to be paying a 7% preferred return as cash flow allows. Years 1 and 2, unless we've essentially underwrote higher vacancy as we stabilize the property. So years 1 and 2, we're not projected to hit that 7% preferred return. But if we do a really good job, and if rents go the way, if rents go up faster than we think they're going to go, then we should be able to hit those returns. And we have done that on a couple of properties that we've acquired in the past couple of years as well. So let's move on a little bit. AJ is going to talk about just the equity raise and a little bit about the financial structure of the deal.
Sure. So it's 40 units. Currently, there's 31 2 bedrooms and 9 1 bedrooms. One of the easy adds is turning the office back into a bedroom. They kind of confiscated a bedroom and turned it into an office to have an on-site manager. But since this is so close to our management office, we are not planning on having an on-site manager. So the south, Chris, can you scroll up a little bit to the picture?
Yeah.
So we're looking at the buildings and we're looking south here. Bertha's on the left, Custer's on the right. The top 2 buildings, we plan on putting backyards in there. So we're going to take the trees out, put backyards for those bottom units. Currently, there's 3 2 bedrooms and 2 1 bedrooms on both of the buildings. So it's like 10 units on the bottom, 10 units on top. There's also laundry rooms in there. So our initial plan is to convert, there's a laundry room in each building. So our plan is to take the laundry room back, and if we can get 2 bedrooms out of it, great. But if we can only get 1 bedroom out of the laundry room, then we're going to add a 1 bedroom back to one of the 1 bedrooms. So for those 2 buildings, we should see an additional 2 bedroom, if not an additional 2 bedrooms. And that will help with the mix of the building. That's increased rents. I mean, we can look at the pro forma, but that's an additional $300 to $400 per unit that we would get in rent from that value add. Chris, if you want to scroll down.
Just one more thing about the value add. When we've done adding yards at another property, and that has enabled us to raise rents and collect significantly more pet rent due to those yards. And those units are highly sought after, the ones that have the outdoor.
Additionally, it reduces the common landscape bill too, so it's literally like a win-win situation for kind of everyone. Um, so it was that project's gone very well, and we're going to use the same architect as well. We've not engaged with him yet, but we've gotten some information from him, which is super helpful. Um, so yeah, the overall project we're probably looking at somewhere between 6.3 and 6.5 million. Required equity, we're gonna be raising 2.8 million. We already are coming in with a 1031, so we already have $400,000 put towards this project. Um, and yeah, our purchase price 5.75 million, as Chris said. I'm gonna turn it back over to him to talk about financing for it. Some things to note on the value add. The previous owners replaced 6 of the staircases. There are 6 additional that absolutely need to be replaced. Um, so that's going to be part of our value add. They've just deferred that as way too long. Additionally, we're going to get the asphalt redone, restriping. The striping looks like some kid came out and did it for fun. So we're going to get that kind of professionally looking. We're going to implement charging for parking. The other 2 laundry rooms have individual storage units. I think there's about 10 storage units per building. So essentially one per unit. We're going to eliminate the 2 in the south buildings and take that space for bedrooms. And in the north buildings, we may take some of that space away just to add in larger laundry facilities. Currently, there's hookups for 2 in each building. There's 2 washers, 2 dryers. There's hookups for it, but they currently only have 1 washer, 1 dryer in each of them. So, it makes sense that the same amount of laundry will be available. It just might be a longer walk for those people on the south building. And we just think we can get more rent out of the 2 bedrooms. Additionally, Chris has drawn a line here. There's some space on the
On
lot.
land.
We do not have a ton of experience with splitting lots, but this could be an opportunity where we could split the lot over the next year and a half and sell it off. Lots in the area are going anywhere from 200 to 350K. So that could be a nice little adder. If it's possible. I'm sure we'd probably want to coincide that with a refinance, because we'd have to get that unencumbered by the financier. So those are issues, but potentials in the near future. It's not something that we're going to tackle right away, but something to look at and a benefit of the property. What else am I missing, Chris, for value add?
Yeah, I think we're good on that area. Yeah, let's talk about loans so far. Right now, I have 3 loan quotes. Chase has the existing loan, and it's 2.7 million. It is assumable, but the fact that it's so low makes it really expensive to assume it, because we would have to raise significantly more funds. But they do have another loan option where they would be offering us 3.6 million. And that is essentially what we're underwriting. Chase has the lowest rates that I've seen so far and the lowest fees. They just do not offer the highest proceeds. So the other lender we're looking at is Freddie Mac, the Freddie Mac small balance loan. And the quote that we've gotten on that is somewhere around 3.9 or 4 million. And if we did choose that loan, then our raise would be a few $100,000 less. So yeah, those are both of our options. They're with the Freddie Mac small balance loan, we have the opportunity to buy the rate down. So it is a little heavier on the fees, but we'd get a loan for 5.5%. With Chase, I think that we're looking at 5.8, although rates did just go down significantly today. I think almost 0.1%, with the change in stance from the Federal Reserve. So that's
What we
exciting.
what we're saying here is we've budgeted for low proceeds, but as we get through the financing process, we anticipate being able to up the proceeds. So that may mean that we need to raise less money or we have a little bit more money for the construction budget.
And if we need to, if we don't need to raise as much money, then the IRR, the return, goes up uh, pretty significantly. The less money we need to raise. So um, if rates go down, if interest rates go down and continue to go down like they did today, then this deal starts looking a lot better.
Hopefully.
Yeah. I guess to touch on a little bit of the financial structure as well. So I mentioned that we're looking at north of a 17% IRR, which has the potential to go up even higher if conditions improve, and then a 7% preferred return. There is the 17% IRR is a after the preferred return is an 80-20 split on the waterfall. And then if we make it above a 15% IRR, and then that is a 50-50 split after that. If anybody has any questions about how IRR or hurdles or waterfalls work, I'm very happy to explain them to you. Yeah. So I guess to take a step back, one of the reasons why we love multifamily and Class C value add is that when you acquire the property, it's already cash flowing. If you compare this to a development model, with zoning and financing and all of the things in a development project, it could be years before a property starts producing cash flow, and it can go over budget, inflation, etc. When you step into a Class C value add, the property is already cash flowing, and the risk on the deal is it's very, very low, as long as you get reasonable financing. And we're very conservative with our financing. We're getting fixed rate loans for 5+ years, and that's exactly what we're doing here. Yeah. So I already chatted about the preferred return. AJ did touch on the project timeline a little bit.
I'm gonna go through it real quick. So we're looking to close end of October, early November. So once that happens, we will implement the value add plan. As Chris talked about, we'll start with the property management value add plan, and plan for the backyards through the winter. So we'll get permits for the backyards, permits for the stairs, and try to do that all at once. It is 4 separate tax lots, so we'll need 4 separate permits, and we'll put in for those, and hopefully the following summer implement that value add plan. All the while, if we have people move out, we toured we toured on Wednesday the property, and I would say 75% of the property had like hard laminate floors, varying conditions. Some looked 10, 15 years old, some looked less than 5 years old. So the lift that we have on this it's a lot of like satin nickel fixtures, plumbing fixtures, light fixtures, and paint, and update the trim. But it's not all the whole complex, which is nice. So I think that we were pleasantly surprised by the condition of a lot of the units, and there are some of the complete classic units with all carpet in, and those are the ones that we will hopefully hit first for renovation, and bring those rents up. So we plan on renovating units and as we implement rent increases, the units become available because people decide they don't want them. We fix them up enough where they come to market rent and re-rent them. So that's usually the first 2 to 2.5 years. So that's kind of where
AJ,
yeah.
yeah, you're kind of touching on the property management value add a little bit. Trent, do you want to just chat about kind of the stabilization period and when we're implementing our property management value add, the rent increases in the rubs, and just kind of like how that is, can be a little bumpy.
Yeah. I mean, the typically the biggest hurdle with it is just getting the tenants to acknowledge and pay the utility costs. In terms of getting the paperwork out, our team is usually pretty good at getting those documents sent out right after acquisition so we can begin those timelines and those clocks to be able to bill rubs and make sure the rent increases are going in as fast as possible. Uh, it definitely, like Chris said, there are some hurdles and some headaches along with that process, but we've done it enough now where I feel like we have a pretty good understanding of that process. And like I said, the biggest hurdle is just making sure the tenants know that it's time to pay rubs and pay for their utilities if they're not paying them already, as well as getting them logged into our portal so it makes it easier for all of them to be able to pay rent and utilities in our online system.
And we actually looked at this on we were doing asset management updates on all of our properties yesterday, and one of the properties we implemented rubs, and it was a pretty difficult process rolling it out. The tenants were not very happy about it. But in the end, all of the costs and the headaches that we received, the rubs income exceeded it, the financial cost of it. And I mean, essentially we were able to just improve the value of the property. And that's one of the things that we love about property value or property management value add. Sorry, AJ, I interrupted you in the timeline.
Well, I mean, I glossed over a little bit of the property management value add, so it's good to explain that. But we expect stabilization anywhere from 2 to 3 years in, and after stabilization, it's like working up the NOI to get to pay those preferred returns and even catch up on the preferred returns. We will unlikely disperse anything in the first year, but after we get a good handle on the property, there's chance that we may end up dispersing some of the preferred return prior to year 3. So then from years
AJ,
3 to 5,
I think we're projected to produce or pay out about half or four
it's like
out of the 7%.
2 to 4% is kind of what we're doing. But I mean,
that would be a conservative estimate.
Yeah.
So, the hope, the hope is that we do pay the full preferred return the whole way through. And we've had projects where that's happened and everything just goes perfectly. The other property that we added yards to, that's exactly what happened.
We actually dispersed extra of the capital that we didn't use on that one too, which was cool.
Yeah. So, we underwrite conservatively, and we're just trying to set expectations. And we also see that this moment in time in the Portland market is, it commercial real estate, multifamily included, not as bad as office, has been declining, and it's not going away, especially multifamily. There's no units in the construction pipeline, and essentially, like we're at a low point. We could go lower, but I firmly believe that with inflation and the lack of inventory, and how beautiful Oregon is, that we are going to see population growth, and it's going to come back. And so, buying into a project that is 5 to 7 years is a fantastic play. 3 to 5 to 7 years is a fantastic play. It's a fantastic bet, especially when it's paying out cash flow, and we're paying down principal on our mortgage, for, if you agree with that, I guess, thought process that, you know, real estate rents are going to go up as people move back to Portland.
Yeah.
So
Kind of to comment on that, like we experienced a rental decline, and that doesn't happen very often,
in
but
22 and 23.
from 23 to 24, July to July, we saw like a 5% decrease in rents. So when that goes down, original rents can only go up 10% from that decline because of rent control in our area. So, and that just makes it harder for, right? We've got some bit like kind of pent up energy in the rents is what I want to say is that these past 3 years they've been kind of stable or down, and this pressure is building up. And what Chris is talking about is the city of Portland has offered 5,000 new units credit of their SDC fees. So they see the problem of there's no developers that are coming to Portland, no new units are in the pipeline. There's literally they're going to finish these new units over the next 6 months, and like nothing's going to start. New development projects typically take 1 to 3 years. So there's going to be a period here in the next starting in the next 6 months for the next like 2.5 years, where there's no new products coming on the market. That's going to create a demand because the supply is lacking in our market, and that's going to create a demand for rental units. And where there's more demand, then the prices evidently goes up. So we are poised for that and looking forward to it.
What are the
The
yeah,
projected
projected rents?
returns,
No, rents for these
projected
units is
rents.
yeah.
So current rents are about, I think it's 1374, is what they're at currently. And our plan is to raise rents slightly in year one to 1400, but as well implement rubs. And then we're projecting a 5% increase each year, for the next 5 years.
And what's market?
Market rent currently, I believe, is 1500 for these units for a two
Yeah.
bedroom. And then what, Trent, would you say 1300 for a one?
Yeah, I'm looking at our notes here.
So we manage a 10 unit or a 12 unit complex down Barber, kind of in a little bit of a worse area, without as nice a green space. And market rents there are, I would say, 1550 for the 2 bedrooms, and then 1250 to 1350 for the 1 bedrooms. And so I would say that's market. And
I pulled up.
and it's been that way for since July of 2021. Like
I
we've been
pull, I,
renting this out for that much since then.
I pulled up Rentometer, and we'll have this in the PPM when it comes out. But median 1698 for a 2 bedroom, and average is 1781.
And then what is the cost? You get a vacancy on one of these 2 bedrooms that need to be upgraded. What and I mean, if you could give me an example real quick, if there's like a $1,300 a month one that needs substantial rehabbing, what's it going to cost to chase $200 a month? What's it going to cost you to remodel that?
So I feel like this is a perfect question for Trent.
Yeah, Trent.
So for a 2 bedroom full renovation, cosmetic renovation, it's probably going to cost anywhere from $14,000 to $20,000, depending on how much you're going to do. We've had 2 bedrooms that we've turned for 16,000.
Mhm.
And then we've had really ugly ones that have cost us about 30,000.
Right.
But I'd say typically that range is going to be anywhere from 15 to 20,000 for a full interior remodel of a two-bedroom unit.
And of
And
the units, oh, sorry.
just to touch on it a little bit more, this property specifically, AJ and I went into every unit
Right.
uh, on Wednesday, and honestly, I we grade our turnovers F, C, and A. I would say more than half of them would be quote unquote A turnovers. We probably have, you know, 7 or 8 C, and then actually no more than that. Like 13 or 14 C turnovers, and then only like 5 or 6 F turnovers. Specifically, I think I only remember walking into 2 units and be like, okay, those ones are, we're going to have to do a lot for those units. But honestly, putting in LVP flooring, we only have to do that in, I think, 5 or 6 of the units. There's only otherwise most of them have hard surface flooring. The cabinets are solid wood, so we can paint and sand all of those. And then, yep, we're going to be changing out light fixtures, plumbing fixtures, maybe some bath cabinets, touch up paint. But all in all, like the property was being run quite well, and even though I guess we forgot to mention this, the property manager is running the property on an Excel sheet. And
There's a tab for each tenant ledger.
I guess
Yeah.
that folio is too expensive for them.
I don't think so. I don't think that they've
Wow.
seen the light yet. So yeah, thank you, Ray. I mean, honestly, in terms of the rest of the presentation, I think we're just happy to answer questions at this point.
Mhm.
Yeah, I think you guys have all, hopefully you've seen the deal summary and the PPM.
Yeah, it's not out yet. We've need to update some stuff from our inspection on Wednesday and just did not have enough time to get that updated. But I'm hoping to have it updated by the time we share this webinar with everyone. So I'm hoping to have it in there by Monday for all the documentation. I was under the assumption that the configuration was 4-1-4-1, and when we came to find out that it was 3 2 bedrooms, 2 1 bedrooms on the bottom.
Yeah, because of the
And
laundry room.
yeah, because of the laundry room. So
Brad, Brad Barton, did you have a question?
Yeah, thanks, fellas.
Go ahead.
All right. So is it possible to see a blank operating statement so I can see how the management fees are paid, like after the call? If you
Yes.
could.
Yeah,
Okay,
absolutely.
perfect. And then can you also include like the charge for the development fee and the syndicator fee with that information?
Yes. Yep. I'm
Okay.
happy to share that's basically our underwriting Excel sheet, and yeah,
Excel. Oh
happy
no.
to share. We charge a 2% acquisition fee, and then property management, I believe we have 6. Is it 6% in there, AJ?
5%, but then there's lease up fees of half month's rent. So it ends up being like 6%.
Okay. And then can you also include a current operating agreement?
Yeah,
And
once
just
I get the
black out
operating
anything.
agreement, the template there, it'll be a blank one. We don't share investors' information with everyone, but
Yeah, just black it out. That's
yeah,
perfect.
yeah.
Awesome.
We'll have that. That's part of the process of like getting everything together, but that should be coming next week.
Perfect. That's great. Okay. Yeah, those are my only questions, but that'd be very helpful to see
And then
those
along with that
items.
will be a template of a subscription agreement too. So Kind of the process is, if you're interested, you let us know how much you're committed for, and then we'll get a subscription agreement, and that subscription agreement you sign, and that gets you into the equity. We ask all investors to wire their money directly to escrow.
Hmm.
It's just safer that way. It all goes to one place, and then once the property is purchased, all of the additional funds come back to us for the operating account, and it's kind of nice for accounting to start on just one day.
Yeah, that makes sense. Perfect.
Ray, go ahead.
Yeah, I don't know how many people on here are new and haven't done it before, but you might want to tell, and it's probably in the agreement, but I don't know if you said it, but you might want to tell them that what skin in the game you guys have.
Oh
Oh,
yeah, it's in there, but we're investing over 150K individually, or Chris and I are together. So
yeah, we're 1031 exchanging a deal we just went full cycle on into this deal.
Yeah, I
So
just wanted to make sure people knew that you guys,
we're
you're not just collecting fees. You're
no, we're
part of the
participating
process.
on the LP.
Yep.
We participate in all of our deals.
Yeah, you do. Oh, I know.
Yeah.
Cool.
um,
Anybody else have any questions?
why don't we go through some of the frequently asked questions? Sale. So, you know, coming down to the end of the syndication, we put the property up for sale. We do have a couple syndications for sale right now. We're selling one, and the other one we have a great loan. It's a 10-year loan, so essentially we've got it listed for what we want to get out of it, but it's cash flowing, and essentially it's a little bit above the market. So that's kind of how we treat a sale, is that we like to put good debt on a property, and then kind of wait for the market to come to us. And right now the multifamily is down, commercial real estate is down, so it's tough to sell a property, but it's a great time to buy one. And so as long as you've got good debt and we're not forcing ourselves into a difficult situation where we have to sell, we're able to just kind of patiently wait out a small downturn. So, yeah. Should we?
We talked about the preferred return of if
Yep.
it's not paid, it accrues, and we catch it up before anything else. Chris and I have been doing this since 2006, 2007, buying properties, renovating them. We started out as it's now coined the Burr method by Bigger Pockets, but we were doing it before it was even coined that. And that's kind of how we built up our portfolio to get where we are now. So,
Tax benefits. So we plan on doing a cost segregation for this property, and with 100% bonus depreciation back retroactively this year, actually, investors will be able to get a solid passive loss for this property and for other properties. So year one, we should see a relatively large loss, probably around.
it's usually like 30 to 60% of your investment. So if you invest 100K, it's anywhere from 30 to 60K loss in the first year. And I know that's a big range, but that's usually what it is.
Yeah, it kind of depends on the building construction when we do the study. But I would expect this the loss to be somewhere around 1.5 million, the depreciation deduction. And so, that's going to be right around 50% of the
Equity
rate.
raised.
So that would be my expectation for that. The property has 38 units rented. And honestly, it's running, 90 98% occupied with this current manager. She does have them a little bit below market rent, but that's also kind of like how we like to operate our properties as well, below market rent. And because we want to keep the heads in the beds. So yeah.
I'm gonna coin that. You guys ought to coin it before I steal it. I'm gonna have a
I think that
t-shirt
we're
made.
the first ones to say that.
Yeah, well, I
Definitely
know,
heard
but
that
I
on
haven't
other
heard it in a
podcasts.
while. But that one's pretty good. Yeah. Oh, it's so different because you guys don't have rent control up there. We'd like to get the heads out of the beds in San
Yeah.
Francisco, but we
We
can't.
we we do have rent control, but it's just we're limited to 10% per year.
Sure. Which is, yeah,
Not as stringent as San Francisco.
correct,
So
correct.
we can chat about our track record too. So this project we bought in 2019, and we're selling it. We bought it for 1.2 million, and we're selling it for 2 million now.
We raised 400,000 for it, so we're looking at like a 840,000 distribution. Plus we refinanced it already, so really it's like 350 of unreturned capital and an 850K gain on it. So it's a pretty good one. And it's going to end up being over 20% IRR for the investor.
This property is the one that is down Barber, near Capitol Highway. Cloverleaf is at Barber, basically Barber and Terwilliger. And yeah, this is also the one that we have listed for sale with good debt, and it's just it's just cash flowing really well. So
It looks like we have a question or a hand raise from Chris
Oh.
Chong.
Yeah. Hey, so yeah, regarding that rent control, like on that last one we did in Hillsborough, Cornelius, like what percentage of the tenants are just gonna take the rent increase and not move out, and then like potentially
More-
delay construction, but that's okay because it's higher cash flow.
More than we'd like. Trent, you got a number on that? I think we've renovated
Yeah,
what,
0.
seven or 8 units over there?
Yeah, but not until after the first. Every tenant just accepted the rent increase, and then when we sent the second one is when we started getting people moving out due to the rent increase.
Okay.
We had turnover just for relocation or whatever, other reasons people move out, but at the time we sent it, that we had 0 people move out because of the rent increase. So every single one of them took it. But now
we actually got a tenant who said they were going to move out, and then they started looking for apartments or other townhomes, and then they rescinded their move out because
that was a different one.
That was Summerfield.
That was
Chris
Summerfield.
Chris Chong's asking about Midland Manor.
Midland.
Oh, Midland. Okay.
Yeah, but either way, I mean, it's all kind of the Portland market. Yeah, and I've seen the same on my portfolio. Like I thought, man, I'm gonna lose a tenant on my rent increases in 3 years in a row. Like no one's moved out. So
Yeah. And I will say that project over in Cornelius, the Midland Manor one, those rents were significantly more under market than this property. This property is still under market, but those ones over there were like, I think they were running like 60% of what market is.
oh wow.
Here, I would say that we're about 75 to 80% of market. So I think
Which
there's
is
a higher
much better.
there's a
for
higher
cash
chance we
flow.
might see some turnover here with a rent increase, but I think that the first rent increase should still do quite well.
Yeah, that's okay. And then you said there's like 2 units vacant now that you just start on the renovations immediately, or is that what I heard?
No, they're rent ready.
Well, those
I
ones
would
don't need any
classify
upgrades.
those as, like they've got hard surface floor, and they're not perfect, but like light fixtures, etc. I mean, all in all, like they're pretty decent units.
The ones that are vacant now, in all likelihood, they'll be rented out by the time we close, too,
Ah.
because that's going to be 2.5 months or so from now. So the current manager has them up for rent. And I guess that's another thing that we didn't touch on is we have the potential. We're in talks with the broker, but we may take over management of this property prior to closing, which means we would be able to implement and start the value add plan for property management prior. We would be careful about that to make sure that we qualify for all the financing that we need. But that could be a significant, opportunity to essentially like take over management and kind of have that changeover on someone else's dime. So,
Right. That's what I thought you were going to say. Yeah.
This project, 6970 Southwest King, was the one we added yards to. And that worked extremely well. So another kind of garden style apartment. I expect we'll be selling this one in a year or two, once we get closer to that mortgage converting to variable rate. Executive Arms. This one was on the east side. We actually bought this from Joe Weston. Got a pretty incredible basis on it. It's doing quite well. Tapiola Manor. Trent has spent a lot of time on this one. What are your thoughts on Tapiola, Trent?
I think it's a good property, but definitely has started turning some of my hairs gray with all the work I've put into that one. But I like the project.
It's cash flowing very well. And it's stabilized now. So one of the other things about this property is that it's in Multnomah County, and a lot of people have been poo-pooing Multnomah County, saying that it's more difficult to operate in. We're actually finding that Washington County is significantly more difficult to operate in these days. It's like, and it's mainly because of evictions. A tenant at this property at Tapiola Manor didn't pay their rent, or hasn't paid their rent since December, and is still in the property, and we're still having to fight with the county and through the courts to get him out, just because he knows how to work the system. Whereas in Multnomah County, he'd be out in 6 weeks, and it's just super straightforward. So Washington County has something broken right now that they're, I guess, working through with the eviction system. There's just too many loopholes. But Cloverleaf is in Multnomah County, and so that'll make it, even more lucrative. Cedar Mill Courtyard is that's our biggest deal so far, and we're still working on stabilizing it. And it's cash flowing. It's doing well. We're having a little bit of renting lull this summer. We're kind of seeing this property is a little closer to Intel, and we're kind of seeing that area get hit a little bit harder because of all the Intel layoffs.
Yeah.
Hey, I got a question, Chris, real quick, and AJ. What any issues at all regarding insurance on a property like this? I mean, because we have just got annihilated in California.
We were getting annihilated earlier this spring, but we found a master policy.
Right.
And so essentially we're able to get insurance significantly cheaper than the market. And then as well, I found a few carriers who are providing incredibly low insurance rates.
Please don't say one of them is Honeycomb.
It's not Honeycomb. But Chris Chong actually forwarded me on to Rohilco, Shane and Matt over there, and they have been finding some incredible deals. And the quote we got for this property is $16,000. So it's about $400 per unit. And it's, that's, it's less than the master policy. So,
right.
We don't plan on ever having any insurance claims.
Oh God, you just jinxed us.
Yeah. I'm knocking on wood right there.
Right. And I was only get married once.
Let me knock on this wood back here.
Yeah, exactly. Exactly.
We don't plan on them. We hope to
Right.
not have them, but I
Agreed.
cannot
Agreed.
rule it out.
Yep.
We really go out of our way so that we don't have one.
No, understood completely.
Yeah. So keep those rates low. Keep the operating budget and the P&L looking good.
Cool.
Summerfield Loop, that's the one in Happy Valley. That's looking great. We're looking at refinancing that one. Midland Manor. This has been a fun project in Cornelius. It's probably one of the rougher properties that we've purchased. But we're doing quite well on turning the units, and it's taking a little bit longer than we thought it would, but all in all, it's happening.
And that property, the revenue has been increased significantly since we took it over.
Yeah. Southeast East, this 13 units in Milwaukee. We acquired this at an incredible basis for 1.65 million, which was the other property that we got for the 1% rule. And we're refinancing this property for 1.53 million 1 year after we acquired it. And so we'll be returning about half of the investors' funds within a year. On acquisition, everybody stepped into, a 15 or 20% gain just immediately. So
also a comment on Midland Manor. If Midland Manor doesn't sell, we're going to be looking at refinancing that. We do have hard money debt on that one until March, but so if we're not in contract by October, we're going to start proceeding with a refinance, and that was overall our plan, is to take 18 months, wait for the second rent increase to come into play, and then refinance that on a T3. So we should be, if Midland Manor sells, that's going to be awesome. But if not, it's going to be probably returning some investors' money on that one and holding it for another 5 years.
Wonderful. Any other questions?
A minimum investment on this one.
Minimum investment on all ours are 50K.
Oh, still 50? Okay, cool.
Yeah, still 50. We haven't raised it to 100. We gladly accept more. On a $2.8 million raise, the max we can take is probably 600K. That's to keep the investor from having to sign on all the loans, become a key principal in the deal. And the loans, you can't have more than 25% of the equity. So that's
Right.
particularly why we do that.
Great.
When Ray mentioned, comments for the newbies, I qualify as one of those. I've never invested in a syndication before. Just to be clear, your investors do not have to personally guarantee the loan, correct?
No,
That's correct.
if we go with Freddie Mac, it's non-recourse. I think if we go with Chase,
non-recourse for us.
if we go with Chase, Chris and I have to probably have recourse, which is fine.
Thanks, guys.
Yeah.
Again.
Yeah,
Great.
see you guys.
All right. Thank you.
Thanks, guys.
Cheers.
All right.